Hey folks, it's Simon here with your Tau Daily video for Thursday the 16th of May 2024. New all-time highs in the SPY and the Nasdaq, pretty much as expected. We got a CPI print yesterday, obviously, which was kind of the talk of the town. And the print was in line. Market was looking for 0.3% month on month for core, and that's exactly what we got. So why do we rally on a inflation print that's in line? Well, I think it's a combination of things. Firstly, at least it wasn't a hotter print, all right? The last 3 or 4 prints have all been hotter than expected. Secondly, Powell has made it so clear at his last few public appearances that the next move in rates is down, not up. The market probably wouldn't have even mattered that much if it came in slightly above expectations even. There's been no real change to pricing of interest rate expectations. The market is still penciling in a cut for September. You might remember that got moved forward from a November cut after the weaker than expected payrolls number we had a couple of weeks ago. So where to from here? Now look, I hate to be a party pooper, all right, when the market is making new all-time highs. Obviously I've been bullish coming into this little run-up, but right now I think is a bad time to be adding risk. I know it feels bullish, it feels amazing when the market makes new all-time highs. And look, let me be clear, there's nothing bearish about a market that's making new all-time highs. But when we get extended, and we're pretty much at that level now, a reversion to the mean becomes a much higher probability. Now, this incredibly strong run we had out of the October low is actually pretty unusual. All right, if we go back in time, you can see, and I'll just squash this chart up a little bit, you can see that when we get to 3 ATRs above the mean, which is this upper red line, it actually doesn't happen all that often. And when it does, the market doesn't usually have much further to rise. Similarly, when we get to this green line down the bottom, the market usually doesn't have much further to fall, and in fact we get a bounce. So these tram tracks can be very useful in just framing where the market is. Right now we're extended. Now, it doesn't mean we can't keep going up, doesn't mean we won't rally for another day or 2 or 3, but it does mean your edge in adding long positions in this sort of an environment is much lower than when you're in this sort of an environment. Keep an eye on bonds here. If use kind of TLT as a proxy, bonds have rallied into, or TLT has rallied into its downward sloping 200-day moving average and this trend line. I don't love trend lines because there's so much subjectivity in how they're drawn, but this one we have got a few points of contact, all right, which gives it some validity. Obviously, put downward pressure on yields, which makes government debts cheaper to fund, and that would generally be bullish for the market as well. But do keep an eye on what's happening with bonds here, because if they roll over and die here, if they get punched in the mouth, equities are probably going to find that a headwind. That's what I got for you. I hope it helps, and I'll catch you on tomorrow's video. Thank you.